And okay, you're live. It's all you.
Okay, so just repeating what I said earlier before we started recording all this. So today is just vertical spreads. I plan to do like a series once a week for 1 hour, and we're just going to be working on how to develop these type of strategies. And it's all open book after I'm going to explain open questions after I explain like 30 minutes of it. And then we'll go over the types of things I'm in, which is mostly credit spreads, because then this is more with you with data. So data is your friend in here. They always advocate this. Like per week, you should probably, if you have a margin account, allocate at least $500. If you have 1,000, just allocate 500 to trade credit spreads because they will help you in the long term. They act as you as a buffer, and they guarantee you to have extra money at the end of the week if you know how to scale these. So the first one that I'm going to go over is a vertical call debit spread. So a vertical call debit spread is basically it's a bullish trade made of a long call and a short call. So a short call is basically so a long call is like where you just a buy option at the ask and you're setting a limit, and the the short call basically is you trying to set a bid at the sell. So like you're basically selling that to the other person basically for whatever price you want to do. So let's say the stock is like it's trading at 215. So let's do one. Let's go to a chart right now. And so we're going to go and we're going to look up a chart. So let's go to trading view and we're just going to look up Microsoft. So this is Microsoft. So Microsoft, if you were bullish on Microsoft ended the week at 219.66 cents. So let's do 220. So we ended the week at 220. If you're bullish and you think Microsoft can go further, what type of strikes do you pick, basically? So basically, when you pick something like that, you always want to consider how far you want to do it. So if you look at the call option prices, that's the key basically. So I'm just going to use Rob trading E-Trade because it's pretty much gives you a probability graph of success. And the way I always do this is that I look at the probability graph, and E-Trades does have a probability graph, so you guys can see how much you're. So basically, if you use E-Trades, you can use their tools on market ideas, or let's see, options, market ideas, ratings, options.
So hey Tiff, before we
What's
get
up?
into digging into that, for the individuals who are kind of on the call who really aren't following along on what a vertical debit spread is, super quick at its absolute core, what's really wonderful about this is it gives you a risk managed approach to trading options. And basically, what you're doing is you're buying and selling a call or a put at the exact same time. So you're paying or getting the reward of the difference between those. And where the benefit comes in, if we talk about trading Amazon, which, as we all know right now, trades at about $3,000 an option. So if you guys wanted to buy an option of Amazon right now, just one naked option, and you want it to go long, you've got to have a minimum of $3,000 in your account, right, ready to go. What's really cool about a vertical debit spread is what I'm doing is I'm buying an option at $3,000 and I'm selling an option at $2,000. So, and actually less than that. Let's say I'm buying an option at $3,000 and I'm selling an option at $2,700. So my net, what I owe somebody, is only $200 between those two, right? And that's what makes me be able to trade Amazon for only $200 of risk, as opposed to $3,000 of risk if that option expires worthless. And that's the benefit of a debit spread among anything, right? And then in addition to that, it's risk managed in that if Amazon drops or increases dramatically in price, then I'm limiting my risk while still enjoying a reward, which is very cool and very beneficial. Obviously, this only works in a margin account. It does not work in a cash account.
Right. So I was gonna say that, but thank you for adding on. So like all of my notes for you guys, like I share all my notes with you. When you do vertical spreads, you always have a bias, basically. Like the bias is basically you are picking a direction, but in the case like a bull call spread, a bull put spread, you have a mentality that okay, it's going in a direction that I think it's gonna happen. So you may if you pay upfront a call spread that is $1 wide, you have a max profit. So I was gonna go do this for you guys and find the tools because apparently why can't I find the tools? Okay, there we go. So option analyzer is like the best tool I've found so far that gives you the probability risk graph. So let's say we're trading Microsoft and you can select a strategy right here. So you're doing a call spread. Their automatic assumption is that you're bullish on Microsoft. So in this case, the ask is at 310 basically. But the bid, the person who wants it, yeah, they're trying to bid for $1.95. And so what your net debit is, or how much you're going to pay, is the difference between 310 minus $2.01. So you're only paying 1/16 for the spread. So if you want to go further, so let's analyze what your probability of success for this trade is and what there is your max loss and max profit. So the underlying stock is trading at 220 right now. So you're trading at 220. The max you can only lose is 1/16. So 1/16, if the stock keeps going up, let's say it goes to 226.19, your max profit for one is that you are only going to get at least 120. So $120 or let's see. Yeah, so here now by next week it's going to be $136. So that makes sense, but when it comes to debit spreads, you always want to close it halfway. You don't want to keep all of it because you don't know what the market will do, and there's always a risk of assignment, but it's really low if you think about it. So this is what happens if you try and make it wider. If you make it wider, basically, let's say you made it $5 wide. So let's analyze the trade. So if you make this trade wider, you bought the 220 for next week, your risk is a lot greater. You are now spending 190 to take on this risk. But your profit is a lot greater. Your max profit went to $300. So that's the trade-off. You are going to receive $300 if it expires in the money, and if it's expired deep in the money, which it kind of explains if you're in one standard deviation, 228. So 228, if it expires there, you're definitely going to get that $300, which the broker will clear for you on Saturday. So that is Microsoft for a very bullish trade. And how much time do you need? It depends on how much time you want. If you want more time, you think that the stock can keep going, but you're betting that, Microsoft will have an amazing earnings run, and you want more money. This is how you start planning. You start planning by, you're going to go a little bit far out, but you're still reasonably in a place where Microsoft can move there in 2 weeks. So you probably would want to short like that, or you can go closer. So you can do like November 6th. So let's do November 6th. So this strategy is bullish still, but let's look, because you're paying a little more time, you have a probability of getting more profit, because the previous one we showed, your max profit was $300. Now your max profit is $300. So this is what happens when you go a little bit more out of money, but you always want to get more time if you're bullish on Microsoft and you think that can go further out. Another thing is that if you can't afford that premium, I always suggest that, okay, if you can't do it, just make it tighter so you can pay less. And you're only going to profit $100 from this trade, but you're only going to lose $160. So and it says right here, your 33% chance of making money by November 6th. It doesn't have to be at November 6th, but it has to be near November 6th so you can close out your spread trade. So here's the expected probability. So it says 75% chance that Microsoft will close below 330 on November 6th, and a 25% chance that Microsoft close above 330. So that's something you want to think about when you're putting up a vertical call spread. So if you're bearish on Microsoft, so let's start thinking about that. If you think Microsoft doesn't have the juice and we can go back to a support, but you don't have the money to do that, so you would try to plan out a reasonable trade. So this would be a reasonable trade because you're only paying $1.03 for this type of trade.
Instead of paying $2.32.
Yeah, instead of paying $2.86, basically you're getting it at a discount. So if you're trading this at this discount, but you also have a max profit. So your max profit, if Microsoft goes lower, is at most you're just going to get 150. And if it's two standard deviations, you're definitely going to get that 150. And if it goes lower, Microsoft you're still going to be profiting off on the short position in Microsoft. Whereas if the stock keeps going higher, your max loss would be what you pay for, which is $103. So in that case, we always want to limit our losses. Like, if no one, I don't think anyone talks about stop losses in debit spreads, but when you do them, you should always be mindful of like what's your stop loss and how much you should take. So about, and usually what I do is that, okay, if we 70, so if the contract price goes above 50% or goes down 50%, that's when I start realizing that I need to cut my losses on a particular type of spread, because it's going to take a really long time for the contract to go back up to where you kind of bought it at. And usually that will happen to you when you start doing them, you start doing a lot of them, that you realize, okay, I'm down like a certain percentage because you're doing enough time. Like the spread trades we did for Apple, I made everyone get a lot of time on those, like June and September. Like I kept telling you guys, okay, I bought it here, I bought it too expensive, but we kept averaging down until we finally were able to sell last week, because I told you guys, okay, we're going to do these again because, you know, we made a good 10% profit because we kept averaging down on every step as we kept going down. As Apple went up, those contract prices that we averaged down on, they were now in profit. So that means we could sell out these with a little tiny profit and towards our break even. But then it was a 10% profit, so I'll take that over anything else. So that's how you do those vertical spreads. With, you think there's more room to go up or more room to go down, you need a little bit more time for them to hit. Or if you're thinking that, okay, it's going to be a quick trade, because you can do these as a quick trade or next week out, but the time you have to open them at a time. So you time them specifically, like as you're timing your option trade, when your entries and your exit. It's the same thing and same concept that you're doing for a spread trade. You still have to time it because you're paying upfront at your call at a discount with a maxed profit. So in this case, you're only limited to down to the max profit of 150. If we go for like what I was talking about, if we do like a $7, that's pretty cheap. So if Microsoft, you did a very wide like $7 spread, and you're only paying $1.89, your net profit would be $5.50, I think. Yeah, so it's $5.50 for max profit. So that's what you will get from Microsoft at expiration. If it closed around there, however, we know that the market likes to go in waves and fuck you over. You always want to close these at halfway, so you better be happy being like, oh, you're up $200 in Microsoft, and Microsoft goes down, you better take that money, because no way in hell I have ever taken max profit, because the risk of assignment is risky, but I have done it before. It's just that if it's deep in the money, I stop caring after, because the broker will do the math for you. They will exercise your contracts, and it's okay if they exercise your contract because you're protected by the short strike. So you're not going to be in risk of assignment of those shares because you have protection, because you're long a strike and you're short a strike, and the broker has to take the difference. So you see the clouds clearing, don't pay attention to that. Robinhood, E-Trades, and TD do what I don't know about Fidelity. Okay, so that goes over the two types of spreads that we're doing. So again, you can buy a in the money put and out of money put. But most of the time, what I always do, I do at least one or two strikes away as the long put and long call. And then I always do like, okay, maybe I do like 2 strikes equal length. So 2 strikes to sell the put or 1 strike away. Because if I want to get closer, less risk, but it's still going to be a good trade. If the next day when you close these out, if in a small account, you're still going to be profitable with a little tiny little credit in the end. Like maybe you can get like $14 or $25. So, so that kind of covers the debit spreads. The credit spreads are something different. So what essentially a credit spread is, it's also a risk-defined trade where, in this case, you're putting up collateral to make a potential move. Like the stock's going to keep going up, you're going to open a put credit spread because you think that stock's going up, but you're providing a certain type of collateral for the broker, so that way you can collect a tiny little profit over time. So let's just change this. So if you were bullish on Microsoft, this is what you do. You sell to open and you buy to open. This is how you do it on other broker, like non-Robinhood brokers. So this is what you do. So you think that Microsoft, and I know this is pretty wide, you have to give up at least $650 of collateral to make this trade. So we'll never do that, because that right there is blowing up your account. We always want to make these tighter, just because you want to define your risk. In this case, since with the risk that we're taking on, we're offering about, if I do the math, so this one is about 250. So 250 minus 60, you're offering $190 of collateral to collect $60. And if you think about that, because beta will work with you, not against you. Whereas in a long vertical spread, like a long put debit spread and call debit spread, these work against you most of the time, because you have to be right about the direction where it's going to go. And if you're not right about the direction, well, it's going to be hard for you to make any money. So these are the type of trades I do every time, every week. And I'll put these on for you guys, because it's important that you don't have to be scared of selling premium, because this strategy over time, I looked at a study saying that if you were just to do selling premium every week, you will beat the market, you beat the gamblers, you beat the house, because you have all the keys, because all the dealer notes and the cameras, you know what the players are playing, because they're risking so much to make unlimited profits. But the slow, steady way of doing it is just being consistent and pulling profits with just using credit spreads. And because you're only collecting a small profit, every time you can stack these. You can offer a little more credit. So let's say you offered, based on your account size, if you were putting up $1,000 to do this trade, in a week, if Microsoft expires above 219, you have easy chance of turning a profit. So this strategy says it has 64% of making money by October 23rd. And if you look at the probability, so it says right here, 36% chance Microsoft will close below 216 by October 23rd. 64% chance of Microsoft to close above. So we want this to close above, basically, because that's how we're going to make money. In this case, this is a risky one. I wouldn't want to do it because the rule is we always want to be at 70% or above. 80% is great. You collect less money, but the probability of you turning a profit in a week is a lot higher. So you could just do this. You can collect a really small credit and you collect 12 cents to kind of offer 200. So let's see. So let's do 250 minus 12 cents. So 230 just to make 12 cents. So you have to decide if it's worth it. If it's not worth it, then you just make it a little bit wider, but then you have to be mindful of the number of contracts you take up.
However, 84% chance of winning, which you'll never see on the other side of the house, right?
Right.
And that's
it's
why
80,
Tiffany and I love this, is because we're the house in the gambling as opposed to the actual gambler. So that's what you got to take into account, is that 84% chance of winning your $12.
Right. So you can win $12 easily. And the week, I think I have some Disney trades going on, and I'm going to show you guys right now. So new tab. We'll go Robinhood because they're on Robinhood right now. So I'm just going to talk about these ones. These all, I'm bullish on Disney. I'm bullish on Win. I just have a naked long spread. So this Win contract right here, this is, I paid 15 cents. I know I put up $150 of collateral because you take the difference between 160, 66.5 minus 65, that is $1.05. So you times that by 100, that is $150 I put up for collateral to make this trade. So at the end of the week, I know the support and resistances of Win. So we look at Win. So looking at Win, that we have to break through at least two levels of support for Win to even fall through to my strike price. It's trading at $71. So this is stuck in the range. And if you see anything that's stuck in the range, you know that the premiums are going to be jacked up a bit because they're expecting something to happen, but it hasn't happened yet. So people are betting like it's going to go there, but at the same time, you know that these major zones that we're building up, it can go both ways. So that way, so Win is trading in a range, and so like another one that's trading in range and has earnings. If you look at IDLM, this is the next one I'm going to be hitting up, but they have earnings, so I'm going to probably do it after. Is that IWM has no, not IWM. IBM is stuck in the range again. So you know this strategy is going to work if you're going to be selling premium because the premiums are jacked up. If you look 30 days out on IWM. This is how I gauge it. If the contract 30 days out on the puts and calls, let's go to 27 on the put side. You see how jacked up the premiums are, and then you know that, okay, IBM can't even go to 118 or 115. If you keep going out, all these contract prices are jacked up 30 days out. And you can collect the most money just knowing the support and resistances of IWM. Like I could do it right now thinking, okay, long credit spread trade, and I'll offer up a $2 wide collateral just to make $52, but I'm guaranteed this money because then there is a major support at what was the one I did? 120, so we're $5 up. So there's major support that we're building up in this area from 122. So 121 to 125, basically that area, 127. So there's likely a chance that I will never go to 120, and this is my strike. I only can lose about $200 from this. So that is a quick credit spread because that's a bullish strategy. So if we look in my notes, let's go to my notes real quick. So this is a bullish assumption. Okay, this is taking a direction. It works best when volatility is low, but it also can work really well when volatility is high. So when volatility is high, we can potentially make some really good trades right there. So, but that works for non-SPY traders. If you do this on SPY 30 days out, it's just crazy right now. Like, I'm trying to avoid SPY because that's how right now SPY is burning people's accounts. So right now we're avoiding SPY because SPY is just too risky for anyone to do anything. And it's basically that we are trying to find ways, taking advantage of other people's tickers, basically not SPY tickers, that tickers in the S&P 500.
Hey, Tiff, do you mind if I show something to the team?
Yeah,
Can I
go
click on
ahead.
the screen for just a second?
Yeah, go ahead.
So this is exactly what Tiffany was just talking about with SPY, right? Now, I am not telling anybody to go do this, but this is super awesome and important. And this is why credit spreads are important. So Tiffany and I were working together, and I created this SPY credit spread calculator. This assumes on week 1, you're starting your entire account with $500. That's it, $500. By the end of 52 weeks, you will have $31,000 in your account by doing these credit spreads. And that assumes you get in trouble like SPY doesn't do what you want it to do every couple of weeks. So I've kind of put that math in here as well, right? Because keep in mind, let's say you are on a credit spread for Hertz, right? And then Hertz announces bankruptcy and it completely crashes. Or Fastly is another great example, right? Let's say you went into a $100 credit spread and then they announce they're changing their earnings and that crashes, right? You're going to lose more money than you're going to gain in that respect. But over time, it's going to add up, right? So you can see I went from $1,300 to $700, but as that happens, I'm going to go from $500 and then within a week, and this is trading SPY twice a week, I'm going to have $31,000 by the end of 52 weeks, trading SPY twice a week constantly. So that's kind of what Tiffany's talking about it adding up correctly. And keep in mind, again, this is me winning 85% of the time or higher, not 2% or 15% or 30% of the trades that we do in naked options. Okay, Tiff, sorry, go ahead. And if anybody has any questions, feel free to unmute or ask in the chat.
Right. So like that is pretty much the schedule I have been putting out day in, day out on SPY when we used to do a lot of SPYs because I noticed this. It was based on a video I got from SMB training, and this guy, he did XPX religiously. He did XPX, and he made it at least 2 strikes wide every time, and he bought 10 contracts per week. He started with $1,000 in his account. And so basically what he did, he traded SPX in the bull market. And I don't know what he's doing now, but the strategy has stayed the same. He is still buying put credit spreads because he knows the market's going to keep going up every time. And that's what we're taking advantage of, knowing that the market direction is still going up. Another thing that I keep sending to you guys, and it doesn't make any sense until if you do a spreadsheet on it. What I've been saying is that if you keep track of these credit spreads you're doing, the calculations over time, you're beating the market, you're beating the people who are buying naked options almost the time, because you're being consistent. You're not taking more risk than what your account has. So let me just start my video. Right, so this one out. Right, so we want to find, how do you find these types of trades? You want to, the major ones that you want to find for really good credit spread strategies is that if they're stuck in a range, like if IBM stuck in a range, or like a really strong ticker it loves to consolidate before a big move. Like Chewy loves to consolidate for a big move. That's why we keep playing this, because every dip is an opportunity for a dip buy, and every opportunity is an opportunity to sell these quick credit spreads, because people think Chewy is going to be shit and it's going to be going down, but we established a range. So that's what we did. So I'm going to end here, because now we're approaching the time, like, I'm hoping that it kind of clears things up, like how you pick them. At the same time, I want to leave it open for questions, because I know Austin's going to be on soon, and so we're going to be asking, letting people like turn on their mics and ask questions how you do certain types.
Yeah, so Tiffany, Santi in the chat just, he said, is there a stock you recommend for limited bankroll since you have to buy 100 shares? I think there's still some confusion there, guys. This is just like options. You don't have to worry about, I mean, it is options. You're just buying one options contract and selling another options contract. You do not have to own shares, and you have very little risk of being assigned to buy those shares. And if that does happen, again, your broker is going to take care of, because again, you're buying an options contract and you're selling an options contract. So they're going to take care of the middle part of that. So it's very limited risk in doing a vertical debit spread or vertical credit spread.
Yeah, the only way that it can go against you is that the stock that, if, like, let's say Tesla, you bought like crazy amounts of Tesla credit spreads, and you bought like, let's say 20, which I would never recommend to do like so much. Yeah, because like you want to limit yourself to a certain number. So I always limit myself to like at least 3 or 5 on a particular ticker. That way it grows the account faster, but you're going to be consistent. Your goal of a credit spread is to let it expire worthless, so you avoid paying extra premium.
Yeah, so another question that just came up from Mark H, and this is beautiful. And Tiffany does the same thing I do in this instance. So her and I have multiple accounts. We have one account that we use for spreads. We have another cash account we use for day trading, right? Really quick trades. And then we have another account used for our long term. And then we have our IRA. And this will be part of the book I'm writing as well. Now,
Yeah,
what's really cool about this is that, and I'm sorry, Tiff, I just want to finish this thought.
Yeah, go ahead.
What's really cool about this is we can create a rolling strategy with our money. We can put $1,000 into our cash account and continually day trade with that $1,000. And then when we get above $1,000, let's say $1,500 or $2,000, we take the money out of our cash account and we put it in our spread account. And then when our spread account, let's say we start the spread account with $2,000, when it gets to $5,000, we take that $3,000 extra out of that account and we roll it into our long-term account. And then, of course, we pay our IRA every time. It's just like paying ourselves. And what we're doing is we're getting out of having a job of day trading every day. And we're not making risky, we all know Banksy on this call, right? We get out of doing that. If I only have $1,000 in my cash account, then I can only max lose $1,000 in my cash account. And same thing with my spread account, etc. So to answer your question, Mark, yes, we do recommend multiple accounts, and I hope that the rolling strategy helps as well. Go ahead, Tiff.
Yeah, so like I have a long-term margin account, which I roll out into my IRA. Like every time I pull a profit, my IRA needs funding. Like it's a really sad account. So anytime money comes in the long-term IRA, long-term brokerage margin account, it gets rolled into the E-trades. Like I can show you, I think I rolled some in already. Wait a minute. I'm probably gonna do that this year for taxes.
Yeah, I usually only do it once a year, rolling in from between my so I have a long-term account and I have an IRA, which is my retirement account. And that's the way I think of it.
Rolling, so I need to roll that. I haven't rolled it for this year. It's too hard. I have to keep track of, I don't know, 10 accounts.
Yeah, I literally only do it during tax, and that's it.
Right. Yeah, I get it. Also for naked, we're not going to be talking about naked selling yet because that's something that you need a lot of money for, and that's something you want to decide if you want the shares, basically.
Yeah. So another thing that Santi brought up, and I do apologize if I'm not pronouncing that correctly, but Santi brings up is that he doesn't have the time to close out contracts if they go red with naked options. That's why Tiffany and I love debit spreads so much, is because you treat them like a swing strategy. I honestly, unless I'm in my cash account, and again, this is not a conversation about day trading. I never go below a 2-hour time frame for the most part, ever, because I can look at the 2-hour daily, weekly, monthly, and I know that a stock's going to go up over the next 2 weeks because it's at my bottom, it's at my supply zone, and it's heading towards my demand zone, something like that. So I don't have to check my stocks every single day. Now, you guys hear me in the chat all the time because you're a fun family, right? But nevertheless, I don't have to do that. And that's why Tiffany and I like debit spreads so much, is because I'm limiting my risk, I'm limiting my reward, but I don't have to put as much focus or effort into them. Even in my long term, what we have is called leaps. I'm sure you guys have heard that. It's an option that expires over 12 months out. All of my leaps, period, end of conversation, are vertical debit spreads. That way, if Bank of America, which I totally own a 30 leap on, right, goes to 24, I'm not going to take as much of a hit on that, but I also don't give a shit because it's 12 months out. But here's another great example of where I make money, space. Well, I bought a 24 something 6 months or so ago. Well, as we all know, space has taken off over the last 3 weeks. So while it was down to $300, $400, $500 over the last 6 months, it was up $3,200 last week. And yes, I totally closed that out, even though it didn't close until January, right? It didn't expire until January. So that's why I like vertical debit spreads in that aspect. Go ahead, Tiff.
We want to close out, like same thing with a long position, with a leap. You basically always want to close it out with profit because you don't want to keep it all the way to expiration. I know like some people want to keep it all expiration. They think they can go there, but at the same time, like you have to be realistic. It costs a lot of capital, and you have to switch. It works. You never want to keep anything for a really long time because it just sucks. It just sits there, and you're like looking at it. It's all about psychology too. You have to think about how much you're risking. So like Apple, I think we were in Apple. I got it like right here. And I kept averaging down like here, here, and then I stop averaging down, and then I just let Apple do its thing before we kind of reach this price target, or we just sold out on this push up right here on Apple. Okay.
Is that your DMs? Good Lord.
That is not my DM.
Oh, okay.
I
Sorry.
have headsets on right now.
Hmm.
Any more questions? Because then this is pretty much part one we're doing. Because next one we're going to be going over iron condors, which is next week. Because I don't feel like we should do it this week since we just went over a big topic.
Agreed. Yes, fully.
Because that just leads into another one that we don't like doing often because it fucks us every time. But you can potentially make more money off of it on just limiting the same number of collateral you're doing up or something else. But we don't like doing it that much. We try to when we see a particular range. Sometimes it is.
So someone
What?
brought up a great point, Tiffany, and you're really good
Yeah.
at this. Someone brought up how hard it is to close debit spreads sometimes.
So just follow a simple rule about debit spreads. Take $10. Okay, $10 for a debit spread, and you can close it out with $10 profit. So that way, like, you're not losing money, but you still got money anyways. So if you think about that, that will really help you with your account.
Sorry, Tiff, I didn't even understand that one. Can you try that a different way?
Okay, so if you bought a debit spread for 50 cents and like the stock went straight up, and it's so hard to close that it's nearly impossible, and the bid is so wide. And like the ask right now is at, let's say it's at 80 cents, and you're trying for 80 cents, you're trying to close it at 80 cents, and the bid price is between like your break even. You don't want to do that. So what you do is that you want to go in the middle part, and you want to go like a few cents lower. Like let's say it's 60, you want to go like 62, so you make like $10 basically. You bought it for 50, so now your net credit will be $13 per spread if you want to close it out. And so that's how I close it out when the stock just shoots up and I can't close it.
Yeah, so much to attempt to simplify that, basically change when you go to close it, don't sell it at what it is. Go ahead and take a few point hit on your profit and close it at a slightly lower limit price, usually a few cents below the mid, and that'll close out. Again, this is a risk managed approach, so it's not going to make nearly as much reward as a naked, but it's got significantly less risk, which is why we like to teach it.
And you can build it up from there. So how I build up the long-term margin was just doing that way. Like I pick a direction, but most of the time I'm always 30 days out because I think that the stock can go there. I've lost quite a bit because you were not aware of that. Okay, yeah, it makes sense, and that's a great question, and you brought up a great point of like how you close it out, because just take a few point hit on closing it, because sometimes, like our if you were trading Google and Google just dropped, or like it went up but you couldn't close it fast enough, you just have to kind of like play around with where it's at right now, because the market makers are kind of fucking you over a bit. But near the bids is the best way to do it. But like you still want to make a profit, so you just make it like $10 or $15. But people still can want to pay can pay like $15 up on the price.
Now, I've been trading debit spreads for a long time, and so has Tiffany. When closing a debit spread, we very rarely have a problem closing those debit spreads. They do happen. Credit spreads are a totally different animal, and that is definitely something we can help you guys through in dealing with those trades and
my God,
those
yeah.
closed. So, but in debit spreads, we very rarely run into that problem. It does happen. Don't get me wrong, but it doesn't happen as often. So we definitely can continue that conversation. And Tiffany and I will be on in the coming weeks, and we'll do some live trading as well on how to do some debit spreads to kind of help you out, as well as conversations around more credit spreads. Right? Credit spreads are a little bit more risky, but again, 85% chance of winning every time. That's good.
So I'll make a spreadsheet if you guys want me to, like, okay, if you're doing $1,000, no, you really have to start with 2.5 because the margin requirements have decreased. This time, like E-Trade says, like you have to have 2.5 grand in your account to do these trades now. So some brokers are carrying volatility and they're shoring up. They're making sure you have enough. So 2.5, you grow that 2.5 to at least 5 grand, you're okay. You're just offering how much you need to shore up capital. But overall, you're going to be consistent every week, and you're going to be just sticking to one particular strategy alternating between spreads for your margin. Because your overall goal is just to grow your margin count to the point where it's up 25 grand, and it takes a very long time just doing that. Especially when you don't have any day trades and you don't have enough capital to do these types of, you're trading on margin, you have to be careful before you get involved.
Yep.
Well, all right, so
Tiff,
so that's about it. So let's stop that recording for now, so that we have a separate recording, and so that way Austin can get on.
Give me just a moment. We're stopping it now.
Yeah, if you want. Yeah.